Today, we're diving into a really fundamental shift happening right at the heart of India's financial system. It's a story about how some of the most important lenders in the country are totally changing how they get their money. And in the process, they're rewriting a rulebook that's been around for decades.
It's a great question, right? For a company to give you a loan, it has to get that money from somewhere else first. And for a massive part of India's credit world, that somewhere else is going through a huge, huge change.
All right, let's get into it. To really understand what's happening now, we've got to look back at how things used to work. For years and years, the strategy for these lenders was pretty simple, and it leaned heavily on just one major source.
We're talking about NBFCs, or non-banking financial companies. These guys are absolutely vital. They're the ones giving out loans for cars, homes, new businesses, you name it. They act a lot like banks, they just don't have the official banking license. And for the longest time, their number one source for cash has been, you guessed it, regular old banks. I mean, think about this. Even as recently as March 2024, a whopping 42% of all the money major NBFCs borrowed came from bank loans. This relationship, this deep dependency, has been the bedrock of the system for ages.
But here's the twist. What happens when that main source, that deep well of money, starts to get a little squeezed? Well, this is where the story gets interesting, because that old playbook just isn't cutting it anymore.
And this is the key point. The problem isn't really with the NBFCs. Nope, it's with their main suppliers of cash, the banks. And when the banks feel the pressure, you better believe that pressure gets passed right down the line.
Okay, this table tells you everything you need to know. First, look at that CASA ratio. That's just a fancy way of saying how much of a bank's money comes from cheap current and savings accounts. See how it's dropping? From 44% down to 39%. At the same time, their cost of funds, what they have to pay for their money, is jumping up. The bottom line is simple. It's getting more expensive for banks to get their hands on money, which means they have to charge more when they lend it out to NBFCs. Now, this isn't just a random market thing. There's actually a huge push for change coming from the very top. The Reserve Bank of India is looking at this system, seeing the risk of being too dependent on one thing, and is now actively pushing for a new way of doing business. So the RBI has rolled out this new framework, and it's basically a strong nudge to the biggest NBFCs telling them, hey, it's time to diversify. The whole point is to build a stronger financial system, where all the risk isn't piled up in one single spot. And they are not being subtle about it at all. They've put a clear, hard number on it. They're telling large NBFCs they need to get at least a quarter, 25%, of their funding from the capital markets. That's a pretty direct order to start looking beyond the banks. So, if NBFCs are being pushed to move beyond the bank, where exactly are they going? Well, let's meet the new stars of their borrowing toolkit. These are instruments that open up a whole new universe of funding. First up, you've got external commercial borrowings, or ECBs. The easiest way to think about this is like a passport for Indian companies to go tap into the giant global pool of money, borrowing from international lenders in currencies like the US dollar. And the growth here is just, wow, a 63% compound annual growth rate in just 2 years. This isn't a slow trickle, my friends. This is a floodgate opening wide as these big NBFCs are rushing to tap into global markets. The second major tool in the kit is the non-convertible debenture, or NCD. This is basically a company saying, hey, instead of borrowing from a bank, I'm going to borrow directly from you, from big institutions, and even from everyday people, by issuing a kind of bond that pays a fixed interest.
And this market is absolutely booming, thanks to a really smart move from the regulators. By slashing the minimum investment from 1 lakh rupees all the way down to just 10,000, they've suddenly made NCDs available to a much, much wider group of people. That massively increases the pot of money NBFCs can tap into.
So what's the big deal about this new toolkit? Well, it's not just about having more choices. It lets NBFCs borrow for different amounts of time, often at better interest rates. It also forces them to be more transparent, which is great for everyone. But most importantly, it opens up brand new fire hoses of cash. So what does all this add up to for the future? Look, this change is way more than just some boring financial shuffling. It's a sign of a real evolution in how India's entire credit system is built. And this chart right here, it tells the whole story. You can see the forecast,
Reliance on bank loans is set to drop, while the money coming from capital markets is expected to climb to almost 2/3 of the total by 2027. That is the new playbook in action, right there.
And that's really the biggest takeaway. This isn't just about NBFCs finding a cheaper loan. It's about building a stronger, more stable financial foundation for the entire country. And that's a foundation that could mean more reliable access to credit for everyone, from a small business owner to someone buying their first home. So it leaves us with this huge question for the future. As these lenders keep diversifying, tapping into money from all over the world and right here at home, are we watching them build a more shock-proof financial engine for India's growth? The playbook has been updated. Now we all get to see how the game is played.